today's session because I know I'm going to get a lot of questions. Brandon, thank you for taking the time with us today. I know you've got a hard stop, so don't be afraid to tell us when you got to go because I know you got to get over for that lunch. So thanks for taking the time. Ladies and gentlemen, this is Brandon Oehlke. He is now my accountant. He's got a great staff that works for him. As a matter of fact, his firm handles 3 of my businesses, my personal taxes, and then also does a lot of the bookkeeping for me. At least pulls my hair out of the fire. So they do a lot of stuff if you're looking into this. The reason why I hired Brandon is one, it's a little bit of nepotism, I guess you could say. I've known his wife since I was second grade, maybe. I've known her forever. But I'll never forget when I actually went in there and I handed him my last tax returns. That was literally the most excited I'd ever seen Brandon. He got really, it's like, and when you could see that somebody loves doing this kind of stuff, I'm like, guess what? You're in charge. So that's why he does what he does for me. But I wanted to bring him on because we're right now at the end of January. Everybody should be getting their 1099s here pretty soon, any other income and all that kind of stuff. I just wanted to talk with Brandon through. So Brandon, just to let you know, these are my realtors. This is going to be recorded. So this is going to go out to all our realtors, but the vast majority of us are also investors. So I just kind of wanted to let you talk about just kind of some of the things they need to be looking for, little tips, tricks, things that they may not be thinking about, things like becoming a real estate professional, those little tax things that we can help with as well. So I'm going to let you do your thing so that way we can get you out on time.
Okay. Well, so I guess we can start with the first thing you mentioned was passive loss limitations. And so the good and bad of real estate can be passive loss limitations, but also not having self-employment tax. So because it is a passive activity, or it can be. But if you guys are all realtors or in real estate, then chances are you could you are or you could be considered a real estate professional in the eyes of the IRS, which means that you have to have 450 hours. And there's not really anything. How do the first question you might ask is how would you prove that? Well, I think there's a number of ways, but a lot of it has to just do with the activities that you have going, if it's reasonable to say that you had that many hours. So I think reasonableness and the number of properties that you're dealing with, what else that you have going, if you have a different kind of business or an 80-hour W-2 job also, then it might be a little harder to justify that. But then sometimes what people will do is maybe have their spouse or something like that be the real estate professional on paper because it makes more sense.
Right. And yeah, guys, that's a little trick that I learned. It's 450 hours. So if you're being a realtor part-time, but you think you've spent 450 hours in a year doing it, step number 1 is document it. I carry a lot of these little bitty just flip books, and I keep one of them that before I was full-time that I would keep my hours in. So as I'm driving, looking at properties, whatever it might be, guys, you got to keep track of that somehow, somewhere. And then you get a pretty big, he used some fancy word for it. I can't remember what it is. But that's good if you're a real estate professional. So track your hours, get 450. Tip number 1.
Right. Sorry, Brandon. So, no, interject. Anybody can interject anytime. It makes the meeting better. So the other thing, so let me explain what passive loss limitations are for those of you who may not know. So let's say you have a rental house on a Schedule E and it has a $10,000 loss. And if your income is over 150 on the AGI, then it starts to get to the point of being held up. So it doesn't mean you never get to take those losses. It just means that if your outside income gets too high, then you can't take them in that tax year, and it'll continue to have those passive losses that you can't take until you either have your income lower or you have passive income in those properties to offset it in a future year, or you sell the property. So that's another thing. So maybe there could be a situation where maybe a passive loss isn't so bad if you're going to turn around and sell it a year or two down the road, because on the year that you sell it, all those losses get freed up, and then you take it and you get to take it against ordinary income. You don't have to take it against the gain, which is better because your ordinary income rate might be, 25 to 40%, but the gain rate, might be 15. So that's a good thing. there.
Yeah.
But ultimately, if you're doing this a lot with whether it's flips or all the different kinds of real estate deals y'all do, when you spend the money, you'd like to be able to take the losses. So if you consider yourself a real estate professional, then you check those boxes in there. You avoid the 88, the 82, 85 passive loss forms, and you don't have to even deal with it.
There you go. So track your hours. That's number one. Brandon, going back, let's talk about real quick, just to make sure everybody has a base understanding. All of the realtors that work for White Line Realty, they're all 1099 employees, which means White Line does not withhold taxes for you. You are considered a contractor, and that is just a stipulation that all realtors are. You are a contractor. You work for us, but you're not an employee, if that makes any sense.
Right.
So
and
we
that's
don't
pretty
withhold
common with most realtors, even outside of White Line.
Right. And so we don't withhold any taxes. So guys, if we paid you $100,000 this year and you were sitting on a fat stack of cash because you're excited, or if you spent it all, you're going to be in trouble because White Line's about to tell the IRS, hey, we paid, I'm picking on Oscar $100,000. And we did not send y'all any taxes of that. So now the IRS is going to know that Oscar has $100,000 that he's got to pay taxes on. Now, depending on his tax bracket, how much money him and his wife make, or as a family, or whatever it is going to depend on how much money he owes the IRS. That's why we file returns. But what we like to do is get as many write-offs as we possibly can. So Brandon, talk to us a little bit about how we go about writing things off and what can be written off as a realtor and what things that are missed often, kind of like the 450, the real estate professional thing. That's missed a lot of times. A lot of people don't know to ask that question.
Well, so to expand first on what you were saying, so whenever you get 1099 versus W-2, then the Social Security Medicare comes through in the form of self-employment tax, but it hits on both sides. So when you're a W-2 employee, the employer pays for half, or 7.65%, and then the employee get the withholding of the other half. Well, on the self-employment tax, the whole thing, or about 15.3%, comes across on the net effect of what gets put down for that self-employment income. And then that's on top of, then you still have the federal side, which could be another 15 to 40% or 37%. So it can get ugly quickly. Sometimes if it's something where you think, hey, I'm in this to make money, I'm going to make money every year and I'm going to make a good bit of it. Well, obviously the first thing is, like you were saying, and we'll talk about expenses and stuff, is to offset as much of that income as possible. And by doing that is the accounting for everything, and not having a big gap between, let's say, what you have left over in the bank at the end of the year and what you have documented that's expenses, and you have this big, huge gap. I mean, that right there can create a lot of issues regardless of how you're taxed. But then sometimes, even after you've done everything that you can to offset the income, then you still have a pretty good chunk left. And that's a great thing, because that means you're successful. That means you're making money, and that means you have money left over. When you have that situation, now we want to be taxed the best way we can. And to being taxed as a sole proprietor may be okay if it's just a side gig and you have enough write-offs to offset things. But if it's your main thing and you're making money every year, then that's probably when you want to go ahead and have an S corp and have the 1099 and all of that go through that. That way you basically have control over how much. There's a lot more write-offs that are acceptable, but two, you don't pay self-employment tax. That doesn't mean that you're exempted forevermore of Social Security and Medicare. What it means is you have control over it. So you're supposed to, as a compliance thing, unless you're either not making money or you're not taking distributions, then you're supposed to give yourself a reasonable payroll. But that, again, that's something you have control over. It's something that you can argue. There's other ways to do that. But basically, it's like an insurance policy saying, hey, I'm going to pay myself $30,000 a year in payroll, which maybe equates to payroll taxes of $5,000-$6,000, and then everything else that I make above that then is free of self-employment tax. So at 15.3% at $100,000 is $15,300. So that one example, you could save probably 15 to 20 grand a year just by having an S corp, maybe more. So that's one thing there too. The other thing is, let's say you're not quite ready for that, or maybe you're in a transition year, and so you have, you kind of got caught by surprise. Well, paying yourself rent, maybe you have some kind of property that you can have an office out of, or some kind of, there's different ways that you can pay and basically recategorize a portion of your income into passive income so that you have less self-employment income. But going through some of the ways, so regardless, there's obviously certain acceptable expenses, more so in S corp, but even as a sole proprietor, when you're self-employed and you have a 1099 income, it pretty much opens it up to the whole world for expenses. And so a lot of people miss like home office deductions and simple stuff like, most people will get simple stuff like your cell phone and different things, but assets, there's a lot of assets that we're all using, even stuff that you've already had, and now you can start depreciating those things. So coming up with an asset list and starting to appreciate everything that you have. Now for 2021 going forward, at least for the foreseeable future, we don't know everything, but we know what it is now. It used to be that meals and entertainment was a 50% deduction. Now it's 100%. And this is the first time in forever that it's been 100% starting this year. That's a big deal there, especially for people in the sales. And in real estate, part of what you're doing is sales. And so that means you're gonna have to meet with people, and that causes expenses. So to get all of that is and especially not be limited at 50%, that's a big thing.
So yeah, guys, so basically anything that you do, any money you spend on your business, you should be tracking. And you should, guys, I'm kind of old school with it. I keep this accordion file right next to my desk, and I put the receipts in my pocket. And at the end of the day, I'll throw them in there. So that way I have them at the end of the year. Some people have just a straight up credit card that they use strictly for real estate stuff. Your mileage can get written off. Your home office deduction. Now, Brandon, correct me if I'm wrong. Is that kind of a red flag for an audit if you're writing off your home office?
No, it's the reason that you think it's a red flag is, well, first of all, so the IRS wouldn't put like a schedule built just for home office and all those things that go with it if they didn't expect you to use it. The reason that it's a red flag is because it's a very common thing that people abuse. And so when they look, and it's pretty easy to identify the abuse, and those are the ones they pick on, and then that's why the reputation of it being a red flag. So with that being said, they're looking to see somewhere between 5 and 20%. I usually target 12 to 15%. There's two different methods to get there, but basically trying to figure out how to justify that percentage of use, because if you don't have at least that, then it's almost not worth doing. But if you're over that 20%, then it better be legitimate, because that is where they'll pick on people more. Usually what happens if it's legitimate, if it is a higher percentage, that means you don't have as many expenses because it's probably a small apartment. And so maybe the percentage is bigger because you don't have as much space, but your expenses aren't as big. So then that makes sense. But people who put 25, 50% use of a home and have 20 to 40,000 expenses they're putting down, that's where it comes in as the stereotypical.
And I'm recording this. If you answer in the affirmative, I may not edit this out. But what I do is I take the square footage of this room I'm sitting in, because this is all I do in this room, right? Mm-hmm. And then I calculate that as a percentage of my home, which I think it's like 11 point something percent. And so then I've got 11% of this home, and then I take 11% of my electric bill, water bill, everything. Boom,
yeah, no, it is everything. Now, one thing is too, so don't do yourself a disservice, because there's certain things that you can take 100% and it's okay, because the things that you could justify, hey, if I didn't have my business, I could survive and I could live just fine without these things, even though we all have them, whether we have a business or not. But things like internet and everything, those are things I take as 100%. But everything else, your gas, your electric, your repairs and maintenance, which a lot of times people don't realize how much maintenance expense they have on their home. and all that stuff, you know, and so the other thing is, so you're doing one room, but it's very common, maybe a whole bath or a half bath that might be close or connected or that's used primarily for what you're doing there. And that's not really used much else. You know, you might say, hey, it's also a guest bathroom, but at the same time, you know, your guests might be people who come in and do business with you. So you could easily justify saying, okay, well, this is the size of the bathroom plus that office. But there's, you know, some people have other spaces that they use in addition. Another trick that I use quite often, especially with people with bigger homes or bigger square footage homes, is you have to look deep into the tax code, and a lot of people don't know this, but there's two different methods to figure the percentage. One is the square footage method, that what you're referring to. The other one is the rooms method. And so many times when you have a bigger home, if you use the rooms method, you can get, because if you use the square footage method with a bigger home, it's real common, if you're completely honest, that you're going to end up at, you know, 3 to 5%. And then it's like, again, hardly not worth doing. So, so with the rooms method, you count every room, not just your bedrooms and bathrooms, but, you know, you got your living room and your kitchen and all that. And in most people, it's common to be, you know, around 12 rooms. It's even with a bigger home, just, you know, a lot of times bigger homes, they don't necessarily have a ton of more rooms. They just have bigger spaces, especially the living spaces, like the living room and stuff. And so then you can easily get to, you know, maybe if you're trying to target around your 15%, you can get there and justify that no problem using the rooms method.
Gotcha. Yeah. So, and that's just another great write-off. And then scheduling from there. So guys, the general concept is, if I made $100,000, the government's going to tax me on $100,000. Okay. That's what I'm going to get taxed on. But if I can show that I spent $40,000 earning that 100, I had mileage, I had a home office, I took so many people out to eat. So all that money gets reduced. So I reduce it by 40,000. Now I'm only going to get taxed on the 60. So that's the general principle on this thing.
Right.
Now, the
key is like you said, is the accounting. So, you know, and there's a lot of different ways to do that. And you were talking about your receipts and stuff. Some people use apps and everything else, but basically getting the best way is, one, you know, try to avoid using cash. And if you do, then you're going to have to make sure you keep those receipts, because otherwise there's no other tracking there. But the other thing is, you know, maybe whether it's spreadsheets or different accounting softwares, but basically accounting for everything that you're doing. Because again, even on paper, something that might be technically, you know, it might have been more personal, but on paper, it looks business as business can be. So accounting for everything, getting everything down. And so that then you have, whether you're doing your taxes yourself or you have somebody to do it, at least now you have everything that you've done, and now you can pick that apart and try to do the best you can at offsetting all that income.
Right. And then I wanted to translate something he said earlier. So now we're down. So we've saved $40,000 and we're only getting taxed on the $60,000, right? Brandon made mention earlier that if you're a sole proprietor, he used that word, which means I haven't really defined myself technically in the eyes of the IRS as a business. I'm just calling. I'm a sole proprietor. I'm doing it. Those people get taxed at a certain rate. If you can say, I'm Colin Corrington, the business, which, guys, you can totally do that. You can do an LLC, a C Corp, an S Corp. There's all kinds of different ways to do it. It's beyond the scope of this, but you move over, that $60,000 as an S Corp gets taxed very differently, and you might be able to save yourself some money. Is it smart for you to do it? I don't know. You need to talk to somebody like Brandon. Okay.
Everybody's different. So
everybody's different.
Yeah.
He just told, literally, Taylor just told me, she's like, yeah, you need to be an S Corp now, Colin. And I'm like, okay, escort me, which I don't know what that means, but we're going to fill out a bunch of paperwork and let the accountants do their thing. So moving forward, so guys, track what you're doing. If you're not talking to somebody, you need to be talking to somebody about this. It's not the scope of this to give you 100% advance notice on how to, or 100% on how to do your taxes in a 30-minute video. So it's really not here, but find somebody. We're just giving you ideas. Now, Brandon, if we are moving over to the investment side of things, a lot of people ask me all the time, should I become an LLC? Should I become an S Corp? Should I do all this stuff if I'm doing investments? And my answer always like, well, it depends.
Right.
It does give you a little bit of a layer of safety from a
Right.
liability standpoint.
Right.
So a lot of people, if we're rehabbing houses, somebody goes in there and the roof collapses, who's getting sued, right? Is Colin LLC getting sued, or is Colin the person getting sued? So
Right.
that is one thing, and make sure you have insurance, guys. Number one, right?
And a lot of
But
people
talk to us a
do. I
little.
mean, if you want to go crazy, some people will have a different LLC for every single property that they have, so that they have different buckets and different layers, so that something that happens with one property can't affect another. I don't necessarily, if somebody thinks they need that and they have enough assets to protect to justify it, maybe so, but I think there's a middle of the ground approach that most people probably do need.
So, but from the tax side of things, I mean, people that are doing things like wholesaling and maybe some flips or rental properties. I mean, where do you suggest that they start? What kind of defines the moment when they need to be considering getting an LLC or doing something like that?
I think a lot of it there's several different aspects, but one of the major things is when they start doing things that kind of change it to where now they're doing things that are going to involve self-employment tax. So if it becomes in the ordinary course of their business and that's all they're doing, then the IRS is going to say that is what you're doing. So now that's a self-employment activity which involves self-employment tax. Then definitely, you're basically going to just get rear-ended big time if you're getting hit on both sides, like I talked about earlier.
Right. Gotcha. So it depends. So you got to go talk to somebody else. I mean, about this thing. For those of y'all that have wholesale, so a wholesale income, Brandon, I mean, that's just straight. That's not even capital gains, is it? If you're selling the rights to a contract, would that just be considered income?
Well, so you're talking. So let's make sure I can understand. So a wholesale is basically you buy a property and you turn around and sell the contract, and
that's
and
before we actually close on it. Yeah. So I let's pretend I'm going to buy your property, and I say, Brandon, I'm going to pay you $100,000 for your property. I get it underneath contract, and I actually turn around to Oscar and say, Oscar, I'll sell you this contract for $5,000. So I keep the $5,000. Oscar takes over the contract and buys your property for $100,000. How is that $5,000 treated?
So who keeps the deed?
Oscar would. I never had the house deeded to me.
I got you. So then
So
that's just that. So those deals right there, that would be considered ordinary income and really self-employment income. And so if you're doing that enough, and if you just do a few of those, then you probably have enough expenses to offset it. But if you're doing that all day long, then that's where you definitely want to get a setup in place to keep you from getting taxed the wrong way.
So that's the heaviest, guys. That's the heaviest. Just straight income is the heaviest tax you're going to get. Period. Right. I mean, depending on a few things.
Basically, what you want to do is there's really not a big advantage to have it tax wise anyway of having a bunch of entities. Maybe you have disregarded. Let me define a disregarded LLC or entity is one that you have just mainly for liability purposes. So you have this LLC, and it's there. It's recognized by the comptroller, the Secretary of State. It's an entity. It owns the property, but in the eyes of the IRS, it's disregarded. You just report it just like you would on your 1040, like it was yours. And so, on properties that you're holding, and for whether you're renting them out or you're holding them and then you sell them, and especially if you can hold it for at least a year, and you can catch that long-term capital gains rate, then you really don't have any advantage. That does just fine just on your 1040. Even if you have those through an S corp, it's going to end up flowing to your 1040 anyway. But so, and that's another key thing too, is if you have a property and you maybe you have a contract, but you're at 11 months, you probably want to delay that so you can get it in to a year, so you can.
So if you're flipping,
right, because it's exactly so, because that's a big difference. It's a huge deal to be taxed at a long-term capital gain than a short-term, because a short-term capital gain doesn't have self-employment tax, which is good, but it is taxed at your ordinary rates, which could be double the long-term capital gain rate.
See, that gave me a really interesting idea. It's like, I got to start talking to my hard money guys about making sure that, because most hard money loans when I am flipping a house are a 12-year term. So after the 12 years, I've got to be out of it. I need to get a 13-month term is what I'm hearing from you if I'm flipping a house.
Right.
And I just
Well,
eat up
yeah.
the full
So
amount
it
of
just
time.
has to be a year or greater. So you just have to make sure it's at least a year.
366 days. Now, the
Yeah.
only thing is you have to weigh the cost of the hard money against that, if you end up holding it for that much longer, if it makes any sense. But
Well, it
that's for
depends
everybody
on
else.
how much
Okay.
money you made. If you made enough of a gain, then I think it would probably make sense for just that little bit of time.
Yeah, for sure. So I promised Brandon I'd have him out of here in the next 5 minutes. Does anybody, like, we've kind of been bouncing around a little bit. Does anybody have any specific questions before we let Brandon go? Because I know this was fast and furious. Oscar, what's up?
I could probably do like maybe another 10 minutes. It'd be okay.
All right, gotcha. I'll hold you to it. Oscar, what's your question?
I was going to ask, I wasn't exactly clear on the wholesale scenario you brought up. So that $5,000, if you're doing that on a regular basis, what type of account or what type of strategy would you suggest get set up to manage that account? Would it be an S corp or?
Yeah, it would definitely be an S corp. I would have an LLC because it's the best liability, but I would have the LLC taxed as an S corporation, and I would have any of the income that has to do with, commissions or those wholesale deals all flow through that.
Through the S corp.
Right.
Gotcha.
Anything that has anything to do with some. And here's another thing too. Maybe you have one entity and you have a little bit of activity that has to do with that, but it's not that much, you want to get it to the S corp. If you can't get it there directly, sometimes you can pay yourself a management fee to basically zero out the income from that other place and then get it to where you want it to be to get taxed where you want it to be.
Gotcha.
That's if you can. Now, guys, it costs, I don't know, roughly $1,100, $1,200 to set up an S corp, and there's a lot more paperwork you got to do. So weigh that into your decision. If you do one wholesale deal a year, it's probably not worth it. If you're, bringing in $100,000 a year doing it, yeah, you're definitely going to want to talk about that.
It goes back to, exactly what you said, because if it's not just, it's not worth it. It's that if you're doing your accounting right, you can come up with enough expenses to offset the small stuff.
Mm-hmm.
Yeah. And here's one rub. And Brandon, correct me if I'm wrong. Now, I heard this from my loan officer, and I've heard this for years now, but if you're not taxed on it, you can't really call it income. Is that correct? I mean, as it comes for, I don't know how much you know about the lending side of things, but if you're not taxed on it, you can't qualify for a loan.
That's a good point. This is a very difficult thing that people have all the time is, so it's many of you probably know this, it's an inverse relationship between what banks and lenders want to see to be able to lend you money and what does good for not having tax liability and not paying a lot of tax. And so that's always a push and pull thing that makes it difficult. One thing that does help, with getting taxed the right way, so that maybe you can show a little bit more income without still make the lenders happy without getting taxed as hard, but like through the S corps and stuff. But there's a couple of other ways, but basically exactly what you're saying. So let's say that you do good with your expenses, you account for everything, and you made, a couple $100,000, but your tax return shows you made 50. And now the lenders don't want to lend you the money that you need to continue your investments. And then you got that issue. Now there's a few little things that lenders, especially lenders that know what they're doing, should always give you, as far as what I call add backs. So to where if you show the 50, then they add the things back, and then maybe you can get to 150 as opposed to giving you credit just for the 50 and still pay the tax on just the 50. Is depreciation. So when you're depreciating any assets, you can add that back, in interest. So depreciation, interest, and taxes. Now, taxes is kind of a tricky one because not necessarily, there's only certain kind of taxes, but let's just, for now, for the simplicity of it, let's just stick with depreciation and interest. So those are two things that can be add backs. Now, some lenders will even let you do add backs for discretionary things, saying, hey, I did these things for tax purposes. They may not weight it quite as heavily as far as what they're saying, but some of them will, but definitely depreciation and interest. So so you can use that as strategies, when you're doing your taxes, depreciating certain things, and the way you're doing your write-offs to try to accomplish both. But it's always going to be a difficult thing to accomplish both.
Yeah, it definitely is a difficult thing. Brandon, I just thought of a very easy question that I think most people that are new are going to want to hear. How, if you're just started being a realtor, right? And I sold my first house and I'm still I don't know, whatever. How much would you recommend out of that commission check that somebody sets aside? 20%, 30%? Just if we're really getting started, what is a good rule of thumb of what you need to set aside?
Well, if you're talking about the gross of that.
Yeah. My growth, like I made $10,000 in commission on selling this house.
I think if you set aside 20%, so in your case, $2,000, and you did some of these, even if you didn't do all of the things, but if you did some of these other things right, I think that'd be plenty. You'd probably end up with some back in your pocket. But if you didn't do anything right and you're getting taxed on that whole thing, you could easily need 35% instead of 20. But if you do some other things right and do 20%, that should be plenty.
Gotcha. And so as we come up on the end of our time, I really want to point out, guys, if you really hear him over and over again say things like, it depends, it depends, it depends. Unfortunately, the tax law, that's what these guys go to college for, okay? And it changes every year. And they have to go read up on it. They have to do all this stuff. The reason why I chose Brandon, or one of the determining factors, is Brandon also invests in real estate. He's got a lot of real estate out and about. And that's why I like him, because I know he's going to take care of his own backyard. You know what I mean? So whatever he's learning, taking care of his own backyard, I know he's going to apply to mine. So I really appreciated that. Now, Brandon is in Seguin. I live in San Antonio. He's right across the street from the Rise. If you've ever been down to the Rise, he's right across the street. So pop in and see him. And Brandon, do you have anything else you'd like?
There was one other thing in kind of talking about a little bit about myself and just about, trying to be kind of the complete person as far as, with building wealth and also with, doing the best you can on your taxes. So one of the things that I try to do is I try to have something in just about every realm that you could think of. That way, no matter what expense that I have, even if it has nothing to do really with what it really is, on paper, I find a place to put it. So I have my goal is to have very few expenses that can't be put on one of my businesses and one of my different places that I could put things. The very simplistic example of that. So somebody who has a rental house and they buy a new washer and dryer. Well, if they don't have a rental house, they can't write that off. If they have a rental house, they bought it, whether they bought it for the rental house or for themselves, then who knows that it wasn't for the rental house. That very simplistic example of that.
Yeah. So guys, get with somebody, plan, think ahead, right? That's the whole thing. There's tax preparation, which is what everybody's doing right now. And there's a whole nother realm of this called tax preparation, where we prepare for what's coming up. Tax planning. Yeah. So guys, get with somebody, find somebody, especially if you're taking this seriously. If you are not setting aside some money every day or making your minimum tax payments, which a good accountant will tell you, Brandon told me, he's like, "Colin, here's some slips. You need to pay them $9,000 every whatever it was. I can't remember what you wanted me to do." But they warn you about this, and they get you in the right place. They get you set up to where you can't fail.
The good news is those estimates, they keep you out of needless penalties. They keep you out of having to come up with a bunch of money at one time, but it's not the IRS's money yet. Just because you pay those estimates, it's not their money yet. It's set aside for that in those tax years for that quarter. But if at the end of the day, if you do all these things right and you end up not needing to use all that, well, you can either get it back in a refund or apply it to the next year. So anyway.
Yeah. Awesome. Brandon, anybody else? Thank you, Brandon. I got to let you go. I know.
Brandon, quickly.
Yeah.
Sorry.
Go ahead.
Do you have a contact number, a good contact number?
Sure. I'll give you the office number. That way, you can get the best service, and my people will start the process on getting you serviced with whatever your needs are. But the office number is 830-379-2991.
And I'll give all y'all his cell phone number later and his personal address so you can just swing by.
Thank you.
Hey, Brandon, I appreciate it. Guys, I know it's a lot of stuff that we're going through, and I know it seemed like a lot of it might have just gone right over your head, but that's how taxes work. And one of the funniest things is I love the quote, and I don't want to make this political, but Donald Trump during one of the debates with Hillary Clinton said, yeah, you're right, I didn't pay taxes. And everybody got so mad at him. But guys, if you do run your thing right, you won't pay as much in taxes. And the reason, guys, is not to avoid taxes, is the government is actually trying to incentivize you to do what the government wants you to do. The government wants you to provide housing because they know they suck at it. So guess what? There's a ton of write-offs if you're in real estate. Okay. If you're doing rentals, there's a ton of rental stuff. That's why I did so many rentals this year, is I needed to be able to bring my taxable amount down. Guys, it's incentives. It's not loopholes. It's not tricks. The government knows what they're doing. Trust me. And they're trying to find you ways to get you to do what they want you to do. And that's why we have different programs like this. So guys, be smart about it. Contact somebody that knows what they're doing. Listen and apply. So guys, thank you so much. Have a great day. Brandon, thank you. Hopefully I'll see you at Dogs in the Green. Are you going to be in that thing?
Yeah. What's the date?
The 3rd of May, I think.
Yeah, that should be a good time. Yeah, I plan to.
All right, cool, man. I'll see you then.
All right, thanks.
All right,
Thanks, man.
thank you.
All right, bye-bye.